Good morning. Welcome to Forex In Four. Today is Wednesday, August 10th, 2011. This morning I'm asking, did Bernanke kill the dollar? And, it looks like this morning we're getting back to a little bit of normal market action. And when I say normal, we still have volatility, but, we're not experiencing the ridiculous swings that we've seen over the past, week or so. This S&P downgrade has obviously got people running and scampering and trying to figure out what to do. All right, and we had the FOMC speech yesterday where Bernanke came out, and what they essentially did that was different from what they've done in the past is the language came out and he said that they're going to keep these extremely low interest rates till the middle of 2013. So it's the first time they actually put a target date on the end. I mean, they've been going with the for an extended period language for some time now, and he actually put a target date on it. So the middle of 2013, that's essentially 2 years out. That means that everybody in the markets can say, all right, free money for another 2 years. All right, that's what they said. And, let's go start buying up stuff again. All right, they're very concerned about deflation now. He's trying to keep the inflation going. He's trying to keep prices stable. All right, and he's hoping that the market's going to help him out. Well, he had 3 dissenters on the board, the FOMC, who said, you know what, we're not fond of that policy. We don't like that. Let's keep the extended period language. It's the first time we've had 3 dissenters since 1992, I believe, when it happened to Greenspan. But in any event, the initial reaction in the market was, oh, this is bad. All right, we had gains of about 200 points in the Dow. Those were erased immediately. All right, and we went negative. All right, until the market realized, hey, wait a second, Bernanke's killing the dollar. That means that we can buy all this other stuff, and boom, market skyrocketed. All right, we had a 600-point swing in the Dow. It finished up 400 points yesterday. So just a really tremendous move. All right, but we can see what's going on here in the markets, and I just want to show you yesterday that we're looking at Euro Swissy right here. And what we're saying is that you can see yesterday, right at the meeting, just an immediate sell-off of euro, flight to safety trade on the Swissy, all right, until the markets realize, hey, wait a second, this isn't that bad, all right, we're going to get this free money pump from Bernanke, all right, off we go. Well, here we go, so we move higher off of that, and I just want to show you and point out this candle right here, 3 a.m. My time in New York, which is essentially the open of the European markets, all right, and Switzerland announced that they were going to provide more liquidity out there, which is essentially a mini intervention. They actually haven't, gone into the market and done anything, but they announced they're going to do it. So that caused a brief little spike there in the Swiss franc. But we know that the franc has been strengthening tremendously. It hit all-time highs versus dollar and versus euro. All right, we can look at this on the daily chart, and you can just see this right here. All right, basically it's well, God, that's just about as good a trend as you're going to see. This is Euro Swissy. We can look at dollar Swissy as well. All right, so that's what's going on with Swissy. I just want to show you gold real quick. All right, gold, boom, same deal. All right, whoops, we're on the daily chart, but you can see here we're nearing all-time highs of that 1780 level. All right, gold is still elevated despite a little bit of respite in the market. Now, they're talking about this morning it looks like the futures are off a little bit, although stocks were up overnight in Europe. We still have concerns about economic growth going forward and what's going to happen. But you can see here the major volatility that you saw in gold yesterday. All right, this was right as here was gold on the flight to safety trade. Same way Swissy went stronger afterwards until everybody realized, hey, wait a second, cheap money, okay? That's going to be inflation, not deflation. So gold sold off, all right, and then it started bouncing back up higher until the market got cooler heads prevailed. So just take a look at the Aussie real quick. You can see same deal, Aussie selling off, selling off, selling off. All right, it comes right down here to the thing, and then boom, takes off. That's a 200 pip move there in about an hour, which was pretty insane actually. So there's a lot going on in the market, and we're starting to get to the point where the fundamentals are starting to come back into play a little bit more. We're going to have to see what happens there, but I just want to show you the pound here. Now the pound's selling off a little bit. They had their UK inflation report earlier, and Bank of England said, you know what? Hey, we've got a weak economic recovery right now. We might be open to further quantitative easing and asset purchases. So he's kind of put that on the table. Mervyn King did. All right, but he's not saying, well, we need to do it now. Just saying, well, we might need to do it in the future, so be prepared. So that's got the pound trading a little bit lower. All right, we also had overnight, we had Chinese trade balance came in. They've got a much larger surplus than expected. All right, their exports went up. Their imports went up just a little bit. All right, but their exports went up tremendously. And listen, I've harped on this, and I don't know how long, but the disparity that China gets, and the surpluses that they're allowed to amass because of their currency peg is really one of the major problems plaguing the global economy. And call it what you will. I mean, China, listen, they have to do what's in their best interests, but it's kind of like, what my best interest is, me doing whatever I want. But if it's to the detriment of other people, then people say, hey, wait a second, you know what? You need to take a back seat, and your interest isn't always what's most important. And that's what's going on with China. Okay, we talk about what GDP means. All right, I've given you this lesson before, but let's go through it one more time. GDP is simply consumer spending plus government spending plus private business investment plus net exports. All right, there's just 4 components, and we have struggling GDP. Well, why do we have struggling GDP? All right, let's go back and think about this. All right, first component, consumer spending. All right, we have consumer spending makes up 70% of GDP here in the U.S., and you know what? It's declining. Why? Because we have 9.2% unemployment. All right, that's a big factor. Well, why do we have 9.2% unemployment? Well, let's skip ahead one to business investment. All right, businesses aren't investing. Why? All right, uncertainty in the markets based on policies coming out of Washington, D.C. All right, they're talking about higher taxes on business. They're talking about this crazy Dodd-Frank bill, which has got regulation out the wazoo. All right, and they're also talking about Obamacare. Nobody knows exactly what that expense is going to be. So there's all this uncertainty. So businesses are saying, you know what? Hey, we're not going to hire in this. We're not going to expand. We may need to, hang on to our war chest. And it's really an embarrassment because corporate balance sheets have never looked better. All right, they've got trillions of dollars on the books right now, and they're just sitting on it. They're not expanding. And everyone says, well, it's because of a lack of demand. They don't want to go out and spend. Well, of course, there's a lack of demand. This is a chicken and egg scenario. All right, you're not going to get consumers to start spending again, okay, until they start to get hired. They're not going to get hired unless business starts to spend. Business isn't going to start to spend unless you remove some of these onerous burdens that Washington's put on them. All right, so it's just this vicious cycle that someone's going to have to break, and you do that by encouraging business first. All right, net exports. All right, that's the 4th thing. Net exports has always been a negative force, okay? We run a trade deficit. We know this. All right, we don't have a trade surplus. We have a trade deficit. All right, one of the reasons is this suckhole called China. All right, the money just essentially goes there with this currency peg. All right, we don't export anything here in the U.S. I understand that. Okay, but we should have a better trade balance that, based on what the true value of the Chinese yuan should be. And Chinese yuan's at something like 17-year highs right now, but it's still only up, what we've essentially seen the Australian dollar do just yesterday alone. So that's really an embarrassment, and that's something that needs to take place. And then lastly, the 4th component, government spending. Well, we just know about this debt ceiling debate that they had in Washington about the budget, and the only answer is cut spending. So it's not hard to see why GDP is going to decline. You got government spending declining. All right, you have no business investment. You have net exports, which are getting worse. Okay, and you have consumer spending, which is declining. And what are they doing in Washington? We need to create jobs. That's what they're saying. We need to create jobs. I don't know why jobs aren't being created. Who the heck doesn't know why jobs aren't being created? I mean, this is truly, one of the biggest crimes of the century, if you will, the way things are going on in Washington. So, you know what? It's going to be more of the same. And you know what? Now that I look back on it, I kind of applaud S&P for what they did. At first, I was a little bit like, you know what? That was kind of a shady deal. But if you think about what S&P did with the downgrade, all right, and this, it just reminds me, like, okay, yes, the U.S. can pay their bills back because they can devalue their currency and just print money and always say, here you go, here's the money. Well, that's going to mean a declining value for other people who receive that money. So there's where the S&P downgrade comes from. But if you think about the S&P downgrade, all right, take a country like China, for example. All right, China has amassed massive surpluses. Okay, they could pay off the entire world's debt that's out there. And you know what? They're only AA rated. Why is that? Well, they can pay back their bills. That's the easy answer from politicians. It's not who has the most money, it's who has the political will to actually pay it back. And that's one of the things. I mean, look at the politics in China. They have all this surplus. Who knows what they're going to do? The politics are so messed up over there. Nobody knows what's going to happen. So it's kind of like, it's like you got a good friend who's, very rich. I mean, put on one of these housewife shows, You see these bimbos walking around. They have all these credit cards, and all of a sudden they can't pay their bills. All right, maybe they have money and just choose not to do it. All right, but they're considered rich, and they have AAA ratings. Let's put it that way. So it's really a statement of politics here in the U.S. and things that are going wrong, and hopefully that's all going to change coming forward. So that's really what we're looking at. I'm sorry for the economics lesson, but I just want to let people know that, you know what, there are solutions and answers. It's just getting away and peeling back some of this onerous stuff that's keeping businesses from hiring. Okay, and if you want to, make these peelbacks contingent upon hiring. I'm okay with that. You know, I'm a conservative. I'm a free market guy. But you know what? If you say, listen, we'll give you the tax break, but you got to hire, I'm okay with saying that. Or we'll peel back the legislation and the regulations, but you got to hire. I'm all right with all of that. That's how you get an economy going, by you know, forward thinking, not this backward looking stuff that's plaguing us right now. So, in any event, that was it for that soapbox. Let's just take a quick peek here. Lastly, I want to look at yen, dollar yen. You can see, all right, intervention in China, or excuse me, Japan did very little. All right, and we are back down near all-time highs for Japanese yen. So we'll have to see how these interventions go down. But that's essentially what we're looking at here in the market. So hopefully today is going to be a day where this whole thing sort of settles and calms down. I don't want to see these wild swings of volatility, but I just want to see a little bit of a pause, a little bit of a contraction here. Everybody take a breath. Everybody step back from the ledge. Everybody realize what's going on. All right, and then hopefully we can get back to a normal course of business. So that's what I'm looking at for today, folks. Good trading to all.